Hello and welcome to another episode of Monday Markets. Hope you all had a very Merry Christmas and a Happy New Year. I'll stop sounding like a greeting card and we can talk about the charts instead. So, I won't do the whole yearly predictions thing. I find that to be a bit asinine, especially in a year which has been driven by macro, and that in itself has been very complicated, and I don't think many people have a predictive edge there. A reactive edge, potentially, a predictive one, far less likely. In my estimation, macro is still going to matter this year, and I'm not going to sit here and pretend I have very clear views as to how that will resolve. We can certainly talk about crypto technicals and some S&P 500 technicals, but as far as the road for 2023, as far as big picture stuff goes, I don't have any predictive power there, and if anyone does, maybe they've got like a decent framework, but in terms of telling you what's going to happen, that's far less likely. As far as that discussion goes, I can sort of speculate as opposed to present knowledge. My best guess is some form of the following, and it's subject to change. I've got two tail cases, which in my mind are the least likely to happen, so maybe up to 5% probability, and then I've got a base case, which is my sort of baseline expectation for the year, and that would be that I think a soft landing, sort of Goldilocks scenario with the Fed, by pulling all these interest rate levers and other tools available to it, manages to bring down inflation, keep it low, and do so without destroying enough demand to cause a recession. That sort of Goldilocks scenario, in my mind, is rather unlikely. If it were to come to fruition, then I think that would be reflected very positively in risk assets. I just don't see a lot of evidence for that at the moment. Again, all subject to change. If the Fed was very late to act on inflation and are now absolutely paranoid that if they do bring it down, that it won't stay down, and they want to have that sort of second whiplash effect. I don't think that, from a timing perspective and from a sort of heavy-handedness perspective, either of those things work in their favor. I think, if anything, they're more likely to overcorrect, to both adjust for the fact that they were late and also make sure that they really get it right and stamp out inflation, even at the expense of the economy, so that they fulfill that part of their mandate. So that's my thinking there. As far as the other tail scenario, it would obviously be like a complete crush, really, really ugly recession, sort of far worse than what's being priced in. Inflation ends up being much stickier than anticipated. The federal funds rate has to go and stay much higher than what's being priced by the market. Basically the polar opposite of that. And unsurprisingly, then we'd expect risk assets to look even worse than they do at the moment by some margin. So those are the tail cases. Again, broadly up to 5% for those. Base case is something just a bit more down the middle, I guess, unsurprisingly, which is that probably some form of harsh landing, maybe not apocalypse type of hard landing, but sort of recessionary in nature, and that risk assets will take a while to sort of chop, churn, consolidate, reprice, and for the effects of the increased interest rates to flow through the economy. Again, maybe this whole section is completely superfluous, but some speculation there, subject to change, as always. Now, as far as the technical stuff goes, if my base case is correct, then the market's mostly going to be range bound for the year. If it does have another leg lower, in my view, that will probably be the final leg. If it does have any significant legs higher, I think those won't be trend forming and won't lead to new all-time highs, just rather trading within different ranges. And I still expect to see a longer and greater volatility contraction in crypto at some point this year. As far as levels go, not much has changed. So the same monthly support at 14k is valid. The same weekly pre-breakdown support turned resistance at 20k is valid, and everything between those levels by definition is far less compelling. So if the market were to puke again, the first real area of monthly and weekly resistance, unsurprisingly, is this 12 to 14k, which I've spoken about at length. If the market were to rally and at the very least reclaim 20k, then when dealing with a failed breakout or failed breakdown on this occasion, I think your conservative take profit for that would be at least 23 to 25k, sort of this consolidation here and maybe the high of that consolidation. That's conservative. If it turns into a real ripper, maybe we finally get the 30k retest. But in any case, if we're looking at where the high time frame levels are, the market's not trading there at the moment. It's not at the pre-breakdown range. It's not at the support yet. It's sort of in the middle and stuck between those levels. So no clear signal on the monthly time frame at the moment. The monthly close just closed as an inside month, which means the price action of the preceding month was contained within the boundaries of the candle before it. You could mark that out if you like as your kind of mini range for this month, where this is the inside month high and this is the inside month low. And you just treat that as a normal range. If it spikes one side and closes above, you look for the other side. If it spikes one side and closes below, you look for the other side. Maybe have a bit of a midpoint, normal type of stuff. I wouldn't give it too much weight because, again, contextually, it's not at the best levels. But maybe for shorter term trading, those highs and lows may be good areas to watch for stitch ups or trap type of setups. On the weekly time frame, still nothing that's terribly interesting. We know that the monthly support area of 12 to 14k is below us. So, just kind of eyeballing where that might fall. It's sort of here in this area, and the market just hasn't reached it yet. It's not trading at any of those levels. So by definition, my swing strategy won't be triggered. In terms of what is available on the weekly time frame, I still think the prevailing sort of structure here is a retest of this deep swing low, and this is previous month's low at some point as well, close below it, and now the market's just in this kind of low volatility drift. So on the weekly time frame, unsurprisingly, the only kind of things that would generate signal would be a finally reaching deeper levels of support, sort of these cyclical levels at 12 to 14k. That would be important. Obviously, the market doesn't have to do that, and you still need a plan to get on board should it not. And in this case, I think a failed breakdown type of pattern would be good enough as a sign of strength for at least sort of preliminary longs and counter trend bounces towards the range high or towards higher reversion targets. So the two choices from a swing point of view that we're left with is reclaim 20k to suggest that this is a failed breakdown, or actually break down the 12 to 14k where we can trade the first fresh test of multi-year high time frame support. This is, as I've said in previous videos, neither here nor there, so the swing strategy has nothing to say about this specific point in price, at least on the weekly time frame. Now, the daily time frame again is where we have most of our candles and the specific range we're working within. The boundaries have remained unchanged, so let me just adjust this so we have the right levels. There we go. And extend it again. Thank you, TradingView, for making my life very easy. There we go. So the lowest close at 16k, highest close 17.6, and the midpoint at 16.7. 16.8 or thereabouts. Last time we spoke was around here, and I made the argument that even if the market were to reclaim the range midpoint, I wouldn't find that terribly compelling as a signal, especially in this case. Not only did that play out, but it also took place during the holidays, so sort of around Christmas and going into Christmas and after Christmas. So the probability of having very large volatile moves in that period was quite low in my estimation. Also, crypto native flows almost aren't a thing anymore. In the past, because crypto is a 24/7 market, even if the traditional markets were closed, we'd still get quite important sometimes crypto price action on the weekends. But given how it's a lot of this is just kind of macro land and correlation trading, and the only volatility vectors that we have come from the legacy world, we don't have much to show for outside of legacy trading hours. So at the moment on the daily time frame, it's just kind of playing ping pong at the range midpoint. It was above it, didn't do anything. Below it, didn't do anything, and it's just kind of stuck at the sort of point of control within the range. And this is where the sort of don't diddle in the middle is at its most prescient, because there's really nothing to do here for me on the daily time frame. And just in general, if you've been trying to make any sort of meaningful moves based off the range midpoint, it's been rough. This looked like a very good support resistance flip, didn't lead to anything. At the moment, you've got tests of the underside using that level from support to resistance, and at the moment it's not really an area that has my attention. As we've argued before, when we're dealing with ranges, especially when volatility is so tight, it's at the extremes where we like to do business. That is to say, at the range high and at the range low, not at the range midpoint. And at the moment, that's not where the market is. I do think, as I've said before, now that we've had a failed breakout at the range high, it's quite unlikely you get a second one, which means any daily closes back above 17.6. I think that would be a good bullish trigger for a more meaningful counter trend move to retest some portion of this pre-breakdown consolidation in around the 20,000 handle. And in general, I think it's good to view the market at the moment as like two separate ranges. So range one was the one that existed before the FTX breakdown. So some version of this, I believe we had, with the range high at 22k, range low at 19k, and range midpoint at 20.7 or thereabouts. You can slice this and dice this in different ways, but you more or less end up with the same pivots. And the second range we're dealing with is the existing one, which we covered moments ago, between basically 16 and 17.6. And these are the two consolidations that we have to work with. And so I think for me, the base case, given my expectations, is going to be level to level. So in the most bullish scenario, if the market does find acceptance back above 17.6, I think there's a trade available there to push into as your first trouble area, the underside of that range at 19k. And if the market finds acceptance there, then you can sort of reposition or look for new longs into the range midpoint and potentially the range high. And all the normal range trading considerations apply. I would normally, again, argue that if it breaks above and closes back within the range, that's bearish. I still think that's technically true, but just these double fake outs are very, very rare. So I would be eager to catch this move from the top of this range into the bottom of the prior range if we start getting daily closes above there or just some sort of acceptance through that level. But that is still resistance for the time being. So that's worth bearing in mind. In terms of the bottom of the range, I'm not allergic to the idea of playing a bounce from that level because you had support, failed breakdown, and then it moved away without retesting the level. So maybe there's some sort of bounce to be had there, even if it is into just a more conservative underside area or the range midpoint or something like that. But this is one of those, this market in general is not one where I'm willing to leave passive orders and, set and forget and then come back and see what's up, especially with headlines flying around. We've got some macro stuff coming up next week, all sorts of DCG, Genesis, drama, Gemini, Earn, beef on Twitter, a bunch of nonsense still that I think requires active management. But my base case is still that, we're not in a sort of not going to be in an upwards trending market, at least towards all-time highs or anything of that sort anytime soon. And in the absence of a strong trend-based directional bias, I simply trade one level at a time, even if that means I sort of miss out on the bigger moves or leave money on the table, what have you. I think kind of holding positions for longer periods has to be justified with reference to the trend and the high time frame dominant trend, and none of that is particularly favorable at the moment. So I think level to level is best I can do. Resistance 17.6 still valid, support at 16 still valid, but not on a blind basis. So those would require observations. Close above, good sign of continuation. But I think the same argument has to be made for the bottom of the range. We've already had the trap at the range low, so closing below would be bad. We've already had the trap at the range high, so closing above would be good. So these are post fake out ranges we're dealing with, not fresh ranges. That does make a bit of a difference, but hopefully we get to talk more about it next week, because at the moment we're definitely in diddle in the middle area, and that certainly, by definition, isn't particularly attractive. I'm just trying to see if there's anything that would make me interested in this. Not really. It's all the same observations as we have on the higher time frames. This is resistance, but except above it, it goes higher. This is support, except below it, then the lows look vulnerable. And a lot of that is still contingent on macro. There you go. The stream from 2, 3, 4 weeks ago, whatever it may be, just as prescient as it was then, because we're stuck in the same range, the same levels, are still doing the same things, and the considerations haven't really changed either. Boring, but that's the state of the market. As far as ETH goes, nothing too dissimilar. Some outperformance through the range midpoint, but nothing to sort of meaningfully shifted market structure or anything of the sort. The positive news for ETH thus far on the higher time frames is that the market is still closing above this 1.1k prior cycles range high. That's good. I think the first real kind of bearish, okay, never mind, the June low wasn't the low type of argument would have to come on the back of a break of support. And while the bounces haven't exactly been anything to write home about, the structure isn't broken either. So spending more time here without a bounce would be scary, but for the time being, purely on a candle close basis, there isn't a ton of evidence to suggest that this level has been violated. The weekly time frame, my views remain unchanged. It's a total pain in the ass trading into the underside of this cluster here. It's frankly untradeable on the weekly time frame. If you just look at these weekly candles, what are we doing realistically? I will go back to my base case observation of bearish weekly market structure on this time frame. So you've got high, low, lower high, lower low, lower high, lower low. It's like, okay, I need to see a shift in that dominant trend or something compelling in order to make me excited or interested in this market. As I've said before, if the market does start to rally, I still think there's a risk of a lower high coming in. And the way we measured that is by simply going from this highest close to this lowest close and going for our standard 618 fib, whatever type of retracement level. But more important than that is that if we take sort of the 618 or the 0.7, whichever retracement you prefer, they all seem to align with this prior level of market structure, this low before the lower high, before the lower low, and so on and so forth. So even if ETH does rally through this underside area and expands from 1.2 towards 1.4, I still have to be very careful at that level, and I definitely can't chase it because it's a prime candidate for a lower high and also lines up with the previous cycle's high at 1400. So that's definitely a resistance level that I would be paying attention to. There is in order to shift this market structure, and the signal may seem late, but it would definitely be a powerful one. I just think making a higher high through 1.5 would be good, because at that point you've got a weekly shift in market structure and a reclaim of the 1400 level, and then looking for some sort of higher low or just consolidation before continuation becomes much more attractive. At the very least you target the highs, if not a larger fill of the summer selling. So that to me is worth waiting for, because the move that it would generate would probably pay for itself. But at the moment, 1.3, it's grinding against that. Whether it's up or down, I think it's a coin toss. But even if it's up, I just don't think there's a ton to capture there, because my system still demands that I pay attention to 1.4K. So lots of messy structure with ETH. On the daily time frame, as we've sort of discussed, it's in a similar range to Bitcoin dollar, just making more progress through the range midpoint. If we do our normal routine of highest close and lowest close and get the midpoint there as well, unsurprisingly, this is what we have. This daily might close above the range midpoint, which would be fine. Again, I don't want to diddle in the middle, and this to me would be diddling in the middle. Thankfully, there isn't a ton of original thought required for ETH, because the considerations are essentially the same. We've already had the fake out at the range high here, suggesting that if there's a daily close back above 1.3, on the weekly time frame, there may not be enough space to take that trade, given resistance is going to move slower on that time frame, or it'll take longer to generate signals. You might be able to squeeze something out of it on the daily time frame. If there's a daily close above 1.3k, technically the argument is still valid to look for an expansion, I think, towards that same 1.4k lower high area potentially. Again, there isn't a ton of space here. There is a world in which you say, oh look, it's closed above 1.3, that's a close above resistance, I'm going to buy it. You end up buying it somewhere close to where the lower high takes place, and then it happens and it smacks you down. That would be shitty. So again, I don't want to project too far into the future. I'll have to make a sort of subjective assessment of whether this breakout at 1.3k is worth chasing into some sort of potential lower high. So for example, if the lower high comes in particularly sort of steep, there is a world in which it forms closer to 1.5k, this pre-breakdown level, and then the move from 1.3 to 1.5 becomes one worth trading. So again, these are all they're all moving pieces here. I think if we sort of zoom out and focus on the basics, this is still our range. A daily close above the range, it would still be a bullish signal. You just have to be slightly careful not to hold it for too long, so you don't hit your head against the weekly time frame. As far as the mid-range, again, not interested. Sorry, I'm sure there's some intra-day, intra-week stuff that could be sort of important, but not for my money, not the range midpoint. Again, we've seen evidence of this here. If you were bullish on this range reclaim, nothing happened. If you were bearish on this range underside reclaim, nothing happened. So it might look like a good level, but the trade ideas that have been actionable as a result have been frankly useless, hence why I'm not spending a lot of energy there. On the downside, I mean, again, similar range considerations. You've got the range low at 1.1k. We know that's a monthly level as well, so you'd want that to be defended in one form or another. Unlike Bitcoin, it didn't actually have a failed breakdown at 1.1k, so that's a setup I would be interested in. So for example, if the market at some point, whether it's now, whether it's after a spike, or from much higher prices, whatever it may be, if it were to come in to this range low and take out these lows and still close above the range low, that would itself, that would be quite a good setup, I think. You've got a fresh range low, a failed breakout or failed breakdown there, I think would be interesting. But for the time being, this is, we're still within the same boundaries, and given it's not a set and forget market, those are assessments we'll have to make at the time. Just being honest. As far as altcoins go, not a lot of them have had my attention. There's Lido's moving and Litecoin's moving, but that's really it. On the BNB front, the market's kind of just gone nowhere for a week. The basic battle is coming off the back of this breakdown here, and the market's just stuck on the underside, but reluctant to move. So nothing particularly actionable there. I think if you start getting evidence of like a break in market structure on the daily, resulting in acceptance in one form or another back above all these lows, then you could start to make an argument that this was the deviation and you trade back within the range midpoint 280s, range high 316. That would be cool, but it's only a failed breakdown if you see evidence of that. And the evidence comes from the market trading above the point of breakdown, so you'd need to see at least daily timeframe signals above the 260 handle. So something to look out for, but again, volatility's been very anemic. I mean, just look at this. It's hard to get excited and also even harder to make videos. So, I mean, leave a like if you enjoy these nonetheless, and, we'll keep them coming. As far as Litecoin goes, I'll let Don talk about this. It's his bag. It's showing good relative strength on the BTC and USD pairs compared to the rest of the market. You can just kind of see that with an eyeball of my watch list at least. And again, Lido there and Solana as well, which we'll talk about. So if you're going to be long stuff, at least be long the stuff that's strong. Technically speaking, this chart's been tricky. A lot of the levels which I thought would produce clearer or better reactions have kind of been choppier than I'd have liked. So there's not a whole lot going on there for me at the very least. What do I want to say about this? I mean, look, this is almost a standard rule I have. If it takes me more than, at this point, 10 to 30 seconds to figure out whether I want to do level with a chart, whether I want to do business with a chart at a certain level, if I can't see it in a very short period of time, the answer is I'm probably fishing and about to make a bad decision. This is one of those, so go subscribe and then tune into DonAlt's Wednesday live stream. I'm sure you can ask him all the questions that you like. The best observation I can make is that of relative strength, and if you have setups, if you want to be bullish and have setups that apply to this market, you're better off with, at least in current conditions, Litecoin than some shitcoin that's not moving. So go to where the green is. XRP, not terribly interesting. You had this, I was watching this overnight, which I found a bit weird, just the spike and close above. It could squeeze higher. Maybe there's some new stuff cooking here. When I trade failed break setups and spikes and traps and anything with a wick, as you know from my video, generally speaking, the wick serves as the invalidation. And so while it may seem counterintuitive, I quite like the wick to be a bit more reasonable than this and not be so detached from, the low and the close. That makes it very tricky to trade those types of trap setups because your invalidation has to be very wide. So not a whole lot there for me. But I mean, this could be just one of those spike and go. That would be okay. But it's one I'll have to miss. Yeah. Let's talk about Solana because that's interesting. Had a very interesting kind of short squeeze here on this candle, and it's just been pushing up higher since then. Now, there was a lot of dumping of this thing on these on these 2 days here. I think the market was down like 1 to 3%, and Solana was down 10 to 15. Some very sloppy end of year selling, it seemed like, or even the market manifesting some form of end of year selling. And then Vitalik came in and tweeted something positive about the Solana development community. That had a big short squeeze type of effect. This is the second one. This is the first one, a big short squeeze. And then I looked at Coinalyze earlier, and what you basically had was after this short squeeze, throughout this bit in price action, open interest was jacked up to the tits, and funding was extra negative as well. So that suggests post short squeeze, there was still a lot of new shorts entering the market, being like, oh, okay, fine, that was the squeeze. I'm going to step in and sell it further now, and it's going to continue lower. And this candle took out a lot of that open interest. So this seems to me to be sort of microstructure games going on, more so than anything fundamental or special with regard to Solana. I mean, Don and I spoke about Solana on Casual Friday. If you want our longer form thoughts, go watch that. Purely from a trading perspective, I'm not terribly interested in fading this at the moment. At least not while the apes keep piling in on every candle, hoping it goes to zero. As far as technicals go, I think the sort of roadmap I'll be using for this asset is a humble one, and it's simply the pre-breakdown range that Solana enjoyed between $12 as the range low, $14.5 as the range high, and $13 as the range midpoint. And you can see at the moment it's right into resistance at $11 to $12. So Not one I want to sell because I think a lot of these short squeezes have been really nasty. Even if they end up being ultimately directionally right, they were far too aggressive and keep getting blown up. So the only thing I could really see is an attempt to reclaim, and then if it falls back outside the range, at the very least I've got an invalidation at that point, and then I can look to trade it towards the pre-breakout structure. That will be fine. I just don't want to be the one selling this one early because that just hasn't ended well for the other participants. But I think the technicals, it's still trading fairly well as far as technicals go. So I would just map out this consolidation on the daily, 12, 13, 14 and a half or thereabouts, and sort of see what we're left with once we have a couple more days of trading. And on the weekly time frame, again, not really a ton of levels to work with in this little inefficient pocket, so any conclusions I come to are going to have to be tentative. One thing I will note is that we are still trading within the first couple of days of the yearly open, and generally speaking, when there's a high time frame candle open, and then a fast and large impulse away from that open, and one that happens quite soon afterwards, I generally look to fade that. So for example, let's say this was our daily open level, and the market just opened and it just pukes straight away into some sort of support. Generally speaking, I'll look to fade that back into the daily open on the assumption that it's likely that the market's going to have some sort of wick or spend more time at that opening range. A lot of it applies to, you can do it on the 4 hour, you can do it on the weekly, on the monthly. I mean, the yearly is getting into a bit of a stretch, but generally speaking, I think the base assumption there is that when you have a new, fresh, high time frame candle open, it's very likely that that candle is going to have a wick on both sides of some sort, or the initial period of that candle formation is likely to be sort of mean reverting. So if there are any outsized sort of early inefficient impulses to one way or another, regardless of direction, around the open, those I like to fade back to the open to sort of spend more time there, retrace to the opening range, form a wick, what have you. So bigger picture, given we're dealing with the yearly time frame, if realistically in the first, I want to say the month of January, but maybe in the first 2 or 3 weeks, if there's like a really big move, especially if it's like not like a trend forming one, something constructive or careful, I just mean like a single candle, big sort of fuck off type of candle from the open in any direction, I'm going to be looking to fade that back towards the monthly and yearly open. I never, as you know from previous live streams, whenever there's a fresh open and just the market just teleports immediately away from it, if I have some good structure, I'll look to fade that. So that's something I've got my sort of ears perked up for in the coming weeks as well. I'm sure there's some earnings stuff, macro, DCG Genesis is still fighting, all sorts of nonsense, still firmly carrying on into the new year. I will quickly round up, I don't know what op means, but I will round up by talking about Legacy, which hasn't opened yet because there's a banking holiday in the US. Nothing has changed for Legacy, which is why I almost forgot to talk about it. I think really the only thing that matters for this month is the market going to hold this monthly cluster of support at 37.10, 37.60. Hasn't quite tested it yet, actually. So as we discussed on Casual Friday, there is a world in which the market opens, somewhere around here, somewhere around the, where the current price action is. Again, it's not trading at the moment. And then you get your drive off the open into support, which trades through these lows, and then some sort of bounce. That would be cool. That would be interesting. But I think bigger picture, sort of thematically, this is really the only monthly support that we have left before the lows become vulnerable and we have to start looking at sort of pre-COVID highs. So this is the only thing I care about is this 37.10, 37.60 handle to see if it's going to act as support. If yes, then maybe we sort of get a bit of a bailout, more range-bound environment between this sort of, at the very least, between 37 and 39 as the first trouble area, and maybe a larger range between 37 and 41. But if this monthly breaks, then I think, that's real doomer scenario, because if Bitcoin looks as it does now and we get legacy lows, we're probably fucked as well. But it's nice when you have levels like this at the 3700 handle that you can basically tunnel vision for your directional bias. If I had to tunnel vision 2 levels, it'd be this 3900 daily weekly and this 3700 monthly, and then get my directional reads from there as far as macro goes. And the final point I'll make before I finally shut up is that a lot of this sort of risk assets are still on the ropes. Bitcoin didn't really do much, still at the range midpoint. Equities, indices specifically, hugging that support. That's been taking place during the most garbage dollar quarter ever. I mean, this thing just turbo nuked and disappeared. So God forbid this thing catches some sort of bid, or bounces from this 102, basically, what is this? 102, 103 support. Basically, anything in dollar that isn't down only would probably fare quite badly for risk assets, because dollar weakness generally means risk assets are bid. Dollar has been weak and risk assets have barely been bid. So then if dollar is strong, I mean, the implication there is if we're hanging on by a pube as it is now, God forbid this thing actually puts in some green candles, we'll be under more stress. So lots of stuff to look out for there. I think the levels are fairly clear. Make sure to leave any comments in the comments section if something was unclear, and I'll try to get back to you. Thank you for supporting Casual Friday, Monday Markets, the Wednesday live streams, the newsletter, all that type of stuff last year. We hope you'll stay with us this year, and I'm going to stop wasting your time. Bye-bye.